Well, good afternoon, everyone, and welcome to another of our TradeStation webinar series episodes. Today, we welcome Karen Smith, an instructor from OptionsAnimal.com, to discuss with us advantages of diagonal option spread strategies. My name is Don Prattle. I'm the Director of Trader Development and Education here at TradeStation, and I'm very happy to have everybody join us for this presentation. If you're an options trader, you would certainly want to know how to trade diagonal options. Our presentation is for educational purposes only. All the symbols and all the trading ideas that we discuss here are for demonstration purposes. They are not recommendations. This presentation is not an offer or a solicitation of any kind in any jurisdiction where a TradeStation affiliate is not authorized to do business. This presentation is not an offer or sorry about that, Ken. Remember that active trading may not be suitable for you because active trading is not suitable for everyone. It carries a high degree of risk and may not be suitable for everybody. Please read your disclosure information in the PDF handout that I've posted in the chat panel. Now we're having some questions over sound. I'm not exactly sure what the problem is today, but I'm sure when I turn it over to Karen Smith, things will be much better. Which I'm about to do right now. Let me welcome from the West Coast, Karen Smith, to discuss diagonal spreads with us here on TradeStation.
Thank you so much, Don. Hi, everybody. How is my voice today? Can you hear me okay? Let's do a really quick sound check. I, too, was having just a little bit of difficulty. Oh, good. Okay, Ken, Alexander, Sandy, John, etc. Fantastic. Thank you so much for being with me today. And yes, it is early afternoon, a pretty afternoon here, actually on the West Coast. So glad to be with you today to discuss what I would say, quite honestly, is a favorite trade amongst our option animal community, and that is diagonal spreads. Now, just to sort of reiterate, of course, the content in our presentation today should not be considered as a recommendation to buy or sell any security. All information being intended for educational purposes only and in no way should be considered investment advice. Options do involve risk, as Don said, and are not suitable for everyone. All rights, risks, and obligations of options instruments should be fully understood by individual investors before entering any trade. Okay, diagonal spreads. Now, can I teach you every single thing, every detail that you need to know on a diagonal spread in the next hour? No, in all honesty, I cannot. But here is what I want to do in the next hour. I want to show you why OptionsAnimal is one of the preferred educational vendors here at TradeStation and with some other brokers as well. I want to show you how it is that we teach individuals to be successful utilizing options in all market scenarios, everything from a strongly bullish market, which we have ourselves again now, to a strongly bearish market and everything in between. How do we do this? Well, we teach a 6-step lather, rinse, repeat process that we use consistently again and again and again for a 90% track record across the years in our trading. Part of that process involves picking the right trades on the right equities at the right time. Okay, we will focus on some of that today in particular when it comes to these diagonal spreads. These can be really fantastic trades. They can get you some phenomenal returns, but they're not the perfect trade in every situation nor on every equity. So how do you begin to determine what might be appropriate for this trade? We'll talk about that today. Another very key piece to that success is the ability to take a trade like this or any of the 20+ trades that we teach and fix them when things don't go according to plan. Now, I probably don't need to tell you that things don't always go according to plan. I've been at this business for many years. I was self-taught with options in 2008, the last great bear market. Being self-taught meant I didn't have all of these missing pieces that I'm going to share with you today, and the result was lost money for me in that last bear market, and that's how I personally found OptionsAnimal. I needed help. I needed education. I didn't want to give up on the sorts of amazing returns we can get in our portfolios utilizing these instruments, but I had to find a better way. And so that's why I became a student of this fantastic curriculum myself in April of 2009. Graduated successfully and now have had the true pleasure for the past almost 6 years. Next month it'll be my 6th year anniversary of being an instructor at Options Animals. So I practice what I preach and I teach what I know. And that's what we're going to talk about today. So very quickly, before I delve into that, let me ask you a question. If you could go back to that chat box as you so kindly did moments ago and let me know how many of you are familiar, to some extent at this point, with diagonal or calendar spreads. Just really quickly, yes or no? Yes, I've heard of them, seen them, maybe do them. No, I've never utilized one of these trades. That just kind of gives me a sense of where I want to take things. And so far, most of you are telling me that you have some familiarity. Okay, a couple of you, not so much, but most of you have some. Excellent. Okay, let me ask you a second question. And thank you so much again for that. A second quick question. And that is, are you closing 90% of these trades and really all of your trades successfully at this point in time? And that's another quick yes or no answer, okay? And most of you are telling me, no, not at this point. And I, believe me, understand what that's like to be at a success rate that doesn't match that. And that's why I want you to stay tuned for what we have to share with you today, because everything you see here, which by the way, will include slides from our curriculum, how we teach these trades. It's very important because this will give you sort of an eye into how it is we at Options Animal have that phenomenal 90% track record. Okay, so thank you all so much for participating there and giving me a strong sense of who you are today. Without further ado, let's take a look at what we'll do together. We're going to look at both sides of the options chain today, both the call diagonal as well as the put diagonal spread. And I will do a little bit of comparing of this trade with what we call a horizontal calendar trade, which some of you may also be familiar with. We'll talk about some specifics when it comes to applying this particular strategy, okay, as we always do. And then we will take a look at examples, answer questions, all of those kinds of things. Also, we will talk about adjustments today, the introduction, if you will, to adjustments. And I do have, by the way, I should have mentioned a special offer for you at the end of our time together today in regards to becoming a member with us here at our fantastic community at Options Animals. So please stay tuned for that as well. So let's talk about this diagonal trade. A diagonal is a form of a calendar. And with these trades, what we are doing is using a time differential element into our trading. We're going to have a long option and a short option, and those options are going to be in different periods, different windows of time. So this diagonal is very similar to a horizontal calendar. With a horizontal calendar, we have both options at an identical same shared strike price, right? With the diagonal, we're going to have a little more flexibility here, where that short option that we will add alongside the long will be at a different strike price than our long option. Now, typically we're going to go 90 days or more in time for the long option, and as short term as a weekly to anywhere from a weekly to, let's say, about a 30-day or so window on that short option. Now, the long option in the trade can be positioned out of the money, could be positioned at the money, or even in the money. Again, one of the ways that this trade can be very flexible. The long option chosen should optimize the expected trend. In other words, if you are bullish, which by the way, if you are, you've been rewarded over the past couple of days, generally speaking, then you're going to want to go with the call side of things. If you're a little more bearish, right, then you're going to want to position on the put side of things for this trade. The short option is still near term, but is placed at a different strike price than that long option. The diagonal is a more directional trade than a calendar. In other words, what we're able to achieve here with our diagonal is not only taking advantage of theta or time decay as we do with horizontal calendars, but we actually get to benefit, make money from a greater degree of actual trend, actual equity movement in this particular version of the time differential trade. So we still get theta, but we also get to bring in delta as well. And again, many of you have experience, and I can tell that. So I am going to be referring to the Greeks and those sorts of things as we go through. Keep in mind, for any of you who may be newer to this endeavor, okay, we don't assume at Options Animal that you arrive at our education with any sort of knowledge. Those of you who have a lot of knowledge, no problem. You might go through early levels of our curriculum very quickly. Others of you will take longer to get sort of the basics, the background that you really need in order to be profitable with options over the longer course of time. Okay, so we're going to start on that call side of things today with the call diagonal. Now, there are some key words here, okay, that are very, very important. A call diagonal is ideal for a slightly bullish trend. Now, slightly bullish doesn't mean big gaps to the upside. It doesn't mean extra strong momentum to the upside. We have other spread trades we can teach to take advantage of those scenarios to a much easier and greater degree than this trade. But however, have you noticed how the markets, with the exception of the past couple of days where we seem to be sort of resuming that momentum in the market once again, but there for quite a few months, we had a lot of difficulty having a lot of momentum, generally speaking. Those are opportune moments when equities are sort of range bound or slow moving, fantastic opportunities for this sort of trade. Okay. So slightly bullish is what we're looking for with this trade. We start with a long call. Long calls make money in a bullish trend. We add to that a short call. Now, short calls alone, by themselves, if you will, optimize a bearish trend. But in this particular trade, they're going to function right alongside our long call, providing potential profitability to us through their theta or time decay. Okay. The thing about directional options, and I'm sure many of you trade directional options, and by the way, guess what? I had long calls on the Russell today, right? I trade them as well. But there are some important caveats, quid pro quos, you might call them, when it comes to those directional options. When we get the timing just right and we get the direction perfect, wow, we get phenomenal results. But if we don't get the timing just right, or furthermore, if we get the opposite trend as to what we're looking for, we can have those really large leveraged losses, which can be very painful. That's one of the reasons why at Options Animal we will teach you long options, directional options, but we teach a lot of spread trades that give you the ability to still make those phenomenal results in your trading, but they can also help you to hedge against not quite the right time, not quite the right scenario potentially for some of your trades. Okay. All right. So we are combining a long-term long call with 3 months or more of time and a near-term short call at different strike prices. How do we determine what short call we want to sell here on this trade? Well, we use the expected price of the equity at expiration. So in other words, we take a look at the charts, okay? We take a look at the strength of the trend that our equity is in, and we get an idea of how far to the upside we expect this equity to move during the time frame of this short call that we are selling. The maximum potential reward is at the strike of the short call when you manage this for a single expiration period. One of my favorite ways to work with these trades many times is to manage them over multiple expiration periods. In other words, sell multiple short options against that base long option that we have in the trade. And when you do that, then theoretically, your reward potential across time is unlimited. This is a theoretical profit and loss graph for one of these trades. Now, our equity is trading right here at the arrow, and I know that might be difficult to see, okay, but it's at about $31 or so. And so here is our break-even point right there, okay, going across. And so the thing that you notice is this is a bullish trade, right? If the equity stays right here at $31, well, we might break even, but more than likely we'll have some sort of slight loss here. We are basing this trade on some degree of bullish momentum. Okay, we are expecting the equity to climb in order for us to achieve profitability. Now, the other thing that you might notice is that this is, in essence, a range-bound trade, isn't it? Because it is possible for the equity to be so strongly bullish, right, that we give back most of the profits. See this tail here at the end? This would be for a more really aggressive bullish scenario. This trade wouldn't perform terribly well. But if we nail this right, okay, if we get really close to the strike price of the short option that we've sold, that's what's represented here at the tip top of the profit and loss graph, okay, that is where we get phenomenal returns. The great thing about this trade, however, is we don't have to get that just perfect. We can be relatively close to that. In other words, the equity may not go all that way or may go a little bit past the short call strike, and yet we can still have some degree of profit in the trade. Okay? Let me ask you something. Back to that chat box if you don't mind. I want to make this interactive today as much as we can. How many of you like to sell premium for profitability in things like an iron condor, for example? That's another range-bound trade, isn't it? It happens to be a trade that we teach here at OptionsAnimal, right? How many of you like to sell premium and do things like an iron condor, for example? That's a trade where we sell premium for profitability, and it's another range-bound trade. I've got a couple of you, okay, using that trade. I love those as well. Robert, John, BJ, yep, I like those as well. But there's a really big difference between this trade and that trade, okay? And one of the big differences is in this pinnacle point, if you will, for profitability, right? When it comes to an iron condor, that's a trade that looks something like, and forgive my crude drawing skills, but it's something that looks like this, and actually this should technically be a straight line going across. But you have a range, right, for profitability, but notice how it's just a straight line going across. Here we have a tip top. If I were to draw an iron condor and sort of impose that here, it would probably be something like that. This trade can actually make more money for us the closer we get to being really spot on to where this equity trades. So our risk reward parameters on this sort of trade, the diagonal, are higher than they are on the iron condor, and yet it's another range bound trade. Okay. Also, and I'm bringing these points up for a specific reason. I can tell that a lot of you have experience, right? Some of you that like to sell that premium are frustrated, like I am right now, most likely in the markets, because with levels of implied volatility so low, it's really challenging, isn't it, to find a lot of good opportunities? Well, sometimes what you have to do is you have to have a toolkit. You've got to have a set of trades so that when maybe some of your favorites might not be present, well, you simply shift, because I can still trade a range-bound scenario. I'm just doing it with another sort of trade, and that's what the market is giving me right now in the way that premiums are priced in this marketplace. That's the sort of full circle education that we give you. You know, the truth of the matter is every single one of us has a certain amount of capital that we're managing in our portfolios, right? And so it's really important that we take that capital and that we apportion it out to different sorts of trades, all in the goal of achieving a desired return for our portfolio, right? So part of that involves understanding where opportunity may lie at any particular point in time in the marketplace, okay? And that's why we wanted to present this trade to you today, the diagonals, because generally speaking, this is what the market is favoring right now in the way premiums are priced. Okay, just wanted to give you that comparison. Let's take a look at a theoretical example here of a call diagonal. XYZ, okay, is trading at $31.50. And so again, our expectation is slight bullishness. That's why we're positioning this trade in the manner that we are. So what we're going to do in this example is buy to open. That's what the BTO stands for inside the curriculum. Buy to open. 132-day strike 32 long call, paying $2.63 of premium for that. To it, we are going to add our shorter term 27-day strike 33 short call, taking in 67 cents of credit. Now, one of the things I like about this particular setup is how much credit we are able to get. Almost 25% of the cost of our long call is being covered in this credit we're taking in on the short call. I love when I can find opportunities like this. The net debit risk in the trade, $1.96. So worst case scenario, completely wrong. Equity makes some huge gap to the downside, okay? And I don't have the ability to make any sort of adjustments, which typically we do, but let's just say worst case scenario, $1.96 per share of risk. We can identify, quantify that risk up front, okay? Now, primary exit is to allow the short call to expire and close the strike 32 long call, or what I like to call a one and done, meaning I'm not going to hang on in this for an extended period. I'm doing this, you know, for this shorter term window, this 27-day window. Secondary exit would be to close at a % net loss or adjust to the resultant trend. And the nice thing about these trades, my friends, is that they're relatively easy to adjust in most scenarios. I mean, do you ever get some sort of really big inordinate gap that can make it a little more challenging? Yes, of course. But most of the time, especially if you choose the right time frame and the right equities, these trades are easy to work with. In a stagnant trend, what might our long call be worth when the short call expires? So what we're doing here is we are saying, okay, let's take a look at how the trade will perform if the equity moves nowhere, if it's completely flat. And then what we get to do is we get to add in the power, the benefit of what will happen if we do get the slight bullish momentum that we're looking for in the trade. So the piece of the trade that will remain in 27 days when our short call expires is the long call. So what we want to do is we want to take that long call and adjust it for theta decay, because over the next 27 days, of course, we know that theta is going to do the thing that it does, right? For our long options, it's going to eat away at some of this premium. So we lose 0.0105 cents a day. We multiply that by 27 days, giving us 29 cents of loss due to theta decay. Okay, so would we be profitable in the true stagnant scenario? Well, we would, because remember, the cost in the trade was $1.96. If the equity's stagnant, we get to keep all 67 cents of the credit we took in this trade, right? That's profit to us in the short call. And now when we take out the little bit of loss due to theta, okay, that gives us $2.29, the value that we could theoretically sell this call back to the market for. So yes, in fact, we are profitable, 33 cents a share. And when we divide that profit by the overall risk that we began with, the $1.96 per share of risk, 16.8% in 27 days. That is in a stagnant scenario, okay? Now, what if we get this kind of right and the equity, in fact, trends up to our strike 33 short call? Remember back to the profit and loss graph where it sort of had that pinnacle point, right? That's what we're talking about. Let's take a look now at what profits in the trade may look like. And I do realize, again, a lot of you with experience, you're using analyzers for this. You're using the wonderful analyzers, for example, that TradeStation provides so that you don't have to do this math, right? You can look at your analyzer and you can change your parameters and be able to tell. But we think it's really key that you understand, that you actually kind of go through this process from time to time. And especially if you're newer, you will learn this process so that you really understand where the profits in this trade and any trade for that matter, where they come from. Because by understanding that, you will also understand the factors that may come to play on a trade that could impact your trade in a negative fashion as well. And so again, I want you to see how thorough we go through our explanations here at OptionsAnimal. Now, what if the equity is slightly bullish and heads up to 33? Now we get to add in delta. And the delta on our long call here out in time is a positive 0.5250 cents per share. Well, if the equity travels from $31.50 to $33, that's a gain of $1.50 a share. And so now when we quote unquote do the math, multiply those together, that means a gain in the long call of 78 cents due to delta. Okay? When we add that back in on top of what was the theta decayed value for the call, you notice in call back for $3.07. That is now a profit of $1.11 a share, or 56.6% on our risk. Now that again is in a 27-day window of time. Hopefully I've got your attention at this point as to why these can be such fantastic trades at certain times with certain equities in the marketplace. You really can achieve some phenomenal results with these trades. One thing I want to draw your attention to, and I said that I would do this earlier, is comparing a calendar and a diagonal. Okay, now remember, a calendar is going to have both the long option and the short option at the same identical strike price. So this would, for example, down here be the strike 33 calendar. As compared to the example we just walked through which is the diagonal. Remember, a strike 32 long call and one strike further out of the money, strike 33 short call. And these are all of your position Greeks, delta, theta, gamma, vega, and rho for the two different trades, comparing them side by side. Okay. So one of the biggest differences between the two is in this first Greek, which is position delta. So with the diagonal, because that short call is at a higher strike price than the long call, we are able to start off with a bigger positive delta at the beginning of the trade. Notice it's almost a third larger to begin with, meaning that if XYZ is a little more bullish, okay, not only can the trade stay profitable for a longer period of time, but we're actually going to make more money because we have a bigger positive delta on the trade. You'll notice that the other Greeks, in this particular example, the other Greeks are relatively similar, theta, gamma, vega, and rho. So this is the biggest beginning difference when it comes to the diagonals versus the calendars. And Ken's got a great question. Ken, I'd like to share this. If the price of XYZ goes up, wouldn't implied volatility go down? And how do you account for the loss of value due to the drop in implied volatility? Wonderful question. Ken, you're an experienced trader, and I love this. I like to call implied volatility, the Greek for that, of course, is right here in our Vega, right? I like to call that one the wild card of trading. And the reason that I do that is because it is challenging to predict how much implied volatility may rise or may fall. Now, our Vega can tell us in a dollar and cent terms how much an increase of implied volatility, how much profit that will bring to the trade, or how a decrease, as you are saying, in implied volatility, how much loss a 1% change will bring to the trade. So that's where, Ken, you have to, when you're positioning a trade like this, you have to take a look at the levels of implied volatility for both options. Okay, the ideal scenario, and I was looking at one of these today on a particular equity where I was considering a put diagonal, the other side of the chain. One of the ideal situations is when your long call has lower levels of implied volatility to it, and your short call has a higher level of implied volatility to it, right? Because the trade overall has a positive Vega, meaning if implied volatility goes up, it helps this trade. Now, as you're mentioning, when an equity moves to the upside, most of the time, implied volatility doesn't go up in that instance. Now, there are exceptions to that rule, right? But generally speaking, and that's one of the things that you do have to watch for, in particular on the call side, right? Because the put side, if your equity is falling to the downside, even if it's slowly falling, oftentimes your options are holding their levels of implied volatility and you don't have as much impact. So it's a very, very good point that you bring up. That again is where an analyzer like a TradeStation would provide for you, where you can go in and sort of work with those values, right? Can be very beneficial to you. So I hope that that helped to somewhat answer that question because you're spot on. Okay. All right. This, you're so welcome, Ken. Thanks for the question. Okay. I asked if the makers here at TradeStation could get me a chart that I thought would be just a really beautiful chart for a call diagonal, and certainly was accommodated. This happens to be Disney, okay? And the reason that I say that this is a beautiful chart for this trade, notice there are a couple of times here, of course, where you have a little bit stronger momentum, okay, to this chart. But generally speaking, particularly since this point in time, this is a thing of beauty for this kind of trade. Not a lot of gaps, right? Not a lot of intraday volatility, just a nice gradual uptrend. Beautiful, beautiful chart right here, okay, for this particular trade. Now, let me say this. Tesla. I don't trade a lot of diagonals on Tesla. It doesn't mean I don't trade Tesla, by the way. We've got plenty of fantastic trades that you can use on the Teslas and the Amazons and the Googles of the world, okay, where you can do really, really well. This kind of trade lends itself more to this type of equity. If you are wanting general, easy maintenance and management, the ability in most instances to make easy adjustments, this is what you're looking for, okay? This sort of equity and scenario. Okay. What I want to do is compare two equities, or excuse me, the two trades, the calendar and the diagonal, really quickly again, side by side. And I'm just going to go ahead and populate this, and then we'll dissect this a little bit in terms of a calendar versus a diagonal. The thing about the calendar that might look advantageous to you, okay, when you're considering these trades, is the fact that because we are selling, the STO stands for sell to open, okay, we are selling to open here in the calendar a call at the same strike price as the long call, both options at the same strike, okay? And with the March call being at the same strike, we're going to take in more credit on this call that we sell at this strike than we will when we sell the March 70 short call, okay? And so the thing that you'll see here is your debit, and thereby your maximum risk, quantifiable dollar and cent risk, is actually going to be lower on the calendar than it is on the diagonal, okay? And so at first glance, you might say, well, why would I ever consider the diagonal then? Because obviously, you know, if I can get a really nice return for less risk, this is the direction to go. But as I mentioned earlier, okay, we can actually make more money on the diagonal, particularly if we really do get to or towards the short call strike that we have sold, we have the potential to make a much higher return. Not to mention the fact that this is a trade because it's starting out with a bigger positive delta. If we get the direction correct, that positive direction, this is a trade that not only can make more for us, but it can stay positive longer. And that you can see in the top two Greeks, delta and gamma. As I mentioned earlier, our delta, beginning delta, is almost, not quite, but almost twice as large from the start, meaning we can handle profit from more bullishness. The other thing that's really interesting is our negative gamma. Gamma is like the gas pedal of a trade. I've used this analogy in a lot of different groups, and it seems that most of us can sort of relate to this one. So I continue to use this to this day. Okay, you know, you've all hopefully driven a car. You've probably driven different cars, right, in your lifetime, and each one of them responds a little bit differently to the pressure that you put on that accelerator. Well, gamma is sort of that accelerator, the gas pedal, in our trades. Sometimes we position trades that have a positive gamma. And what positive gamma means, I call it pedal to the metal, right? Where you floor it and you take off. We have trades with positive gamma. That's exactly what you want to have happen, okay? Now you might notice for this particular trade, we actually don't have a positive gamma. We actually have a negative gamma. So with a negative gamma on this trade, what that means is it's not so much a pedal to the metal scenario as it is, let's set it on cruise control. Let's put this thing on 40, 45 miles an hour and let's just cruise ourselves into a profitable conclusion. That's really what we're looking for here. And in fact, if we had pedal to the metal in terms of price action, a big gap to the upside and lots of momentum, that actually can be a headwind for this particular trade. And again, that's why I say certain equities at certain times lend themselves to this trade. But in terms of comparing the two side by side, the thing that you notice is that our gamma, while negative on both of these trades, it's less negative, almost a half less negative on the diagonal. Once again, we are set up to make more money from bullishness with the diagonal as compared to the calendar. I'm not going to tell you I never do calendars, the horizontal calendars, but the thing I have found over the years is that diagonals, because of this sort of forgiveness, unless you are really, really, really good at getting those prices absolutely right on a consistent, and I say, we call it pinning, right? When an equity pins to a certain strike price, finishes right at a certain strike price. If you're not as great with that, if you don't have time to sit and watch as carefully, the diagonal is going to be a more forgiving trade, generally speaking, for you. Okay. So the greater debit in the diagonal means greater risk. The greater delta means the trade is more sensitive to price movement, as I have said. Gamma is less negative, so the trade stays bullish for longer and has a higher break-even point. Now, something I didn't draw your attention to on the last slide was theta. In a truly stagnant equity is going absolutely nowhere scenario, the calendar will outperform. Okay, and that's because you took in more credit with that short call, your debit is lower, and you really are relying 100% on the different rates of theta decay between the long and short calls in the trade. Okay, so in a stagnant trend, the calendar will outperform. Larger vega, the trade stands to benefit more, that is the diagonal trade, if there is an increase in implied volatility. And I'm watching these markets and we're breaking out to highs and things like that. And as I said, for those of us who like to do credit trades, it's getting more and more challenging all the time to find great opportunities to do those kinds of trades, which our portfolios get lent to this sort of trade, particularly if you position this at a time where your implied volatility, particularly on your long option, is relatively low and can potentially go higher. Okay, that can be of great benefit to you in this particular trade. You choose the strikes that fine-tune your expectations with your trade. Okay? So, in terms of managing this trade, what we want to do, there's a couple of different ways. I mentioned earlier we have a 6-step lather, rinse, repeat process at OptionsAnimal. Okay, 6 repeatable steps. Everything that we teach in our 8 levels of curriculum boils down to that. And one of the key steps, they're all key actually, but one of the really key important steps, and this is sort of where OptionsAnimal sets itself apart really from anyone else at this endeavor, is teaching traders how to plan for the good and for the not so good. How to plan for when it's time to take profits in a trade, because let's face it, sometimes we have a tendency to hang around a little too long and we watch profits turn into losses, as well as knowing when, knowing why, and knowing how to fix things when they aren't going the way that you expected them to go. So the 4th step of this 6-step lather, rinse, repeat process is all about that. We call it primary and secondary exits. Okay, you always want to know where the exit is, right? You always want to know where the escape hatch is. So in terms of the primary exit, this is where, hey, things work out. My call diagonal, equity is nicely bullish to the upside and provides me the opportunity, for example, to close this trade with a certain percent return. Now notice we've got 25% in here, but anywhere from 25 to 50% is certainly reasonable with these kinds of trades. You could close your long call regardless of degree of profitability when the short call expires. The time to consider that would be trend is beginning to wane. Trend could be beginning to change. Maybe you no longer expect further bullish momentum with your equity. That might be a time where you would consider. I have done calendars like that and diagonals like that where I've gone in and the equity is moving nicely and the trade is progressing and I've got 8%, I've got 10%, I've got 12% profits in the trade. And then, you hit a resistance point, you sort of hit a wall, whatever the case is. Equity isn't moving any further. That's when I start to evaluate, and particularly if it starts to roll over. And we have some technical chart indicators that we teach in the very first level of our curriculum that help us spot those things so that we can see if a trend is starting to wane. Perhaps we need to take a look and say, okay, is this something that I might want to close out? You never go broke taking profits, right? It's good to let your winners run, but you never go broke taking profits either. And that's something that you always want to keep in mind. You can also continue to manage this trade over, as I've mentioned earlier, multiple expiration series. continuing to short calls against the long call. Now, secondary exits, okay, this is that escape hatch, if you will. Obviously, we can close at a loss, or we're going to adjust this to the current trend. Now, that current trend may be more bullishness than what we expected. That current trend may be a greater degree of flatlining. That current trend could even be the opposite trend in this case, which would be a bearish trend. We teach adjustments for all of those possible scenarios. Every one of the 20 plus trades that we teach, these diagonals being one of those trades, every trade has its own methodology for adjustment. So I like to call us full circle. There are others who can perhaps explain to you what a diagonal is. But in terms of really teaching you the sorts of equities, the time frames, the Greeks, and of course the management of that trade, that is where we excel. Okay? Here at Options Animal. So if the stock is slightly bullish to stagnant, we should be able to close this at that percent gain. If it starts to move bearishly, for example, we can sort of, I call this trailing price action. Roll the short call to a lower strike price, continuing in the trade, or close at a percent loss if it's more bullish than what we had expected when we started the trade. I've had this certainly in this bull market run. I've had this happen a few times. Secondary exit, roll that short call to a higher strike price further out in time, or close the trade. Now, these are just the beginnings of the management of this trade. There are a lot of considerations when it comes to adjusting these various trades, and we get into a lot more detail, obviously, inside the curriculum. Let's move to the other side of the chain, and that's going to be the put diagonal. And to be honest with you, this is sort of the side I favor. Now, I say that on the one hand, and then I'll tell you on the other hand, not as many opportunities in a bull market, right, for this sort of trade. But the reason that I favor this side is exactly what Ken asked about a little while ago, and that has to do with that wild card of implied volatility. Because when an equity is in fact falling, it has a tendency, if its implied volatility is not increasing, if it's sort of a gradual sell-off, you might not get a lot of increase in implied volatility, but you typically don't see a lot of dropping in implied volatility. If, however, you position this at just the right time, so for example, we have and I mentioned the technical indicators that we teach in the first level of our curriculum. We have 3 in particular that when they line up at a particular point in time, okay, they can be very indicative of trend change. So let's say that you got those 3 lining up, indicating potential bearishness. And yet your equity hasn't really at that point begun to truly behave bearishly yet. You're kind of in a little bit ahead of, if you will, the price action in terms of your indicators. That can be a great time to set up a trade like this, because then when the bearishness is confirmed, when the equity does in fact begin to move to the downside, you're a little bit ahead of the game, and you can pick up profitability just from the increase in implied volatility. Okay, so it can be a wonderful time. And Mo's asking, what are those indicators? Mo, we teach those inside the curriculum. Okay, there are 3 very common technical indicators. It's really just the way we piece it and put it together. Okay, and they're really reliable across the years. Let me tell you, I've been trading them a long time. They're quite reliable. So the put diagonal, once again, here's that word again, right? Slightly bearish trend. We're not looking for the big gaps. We're not looking for huge corrections here. Okay, there are better trades to position for that. This is for just that equity that just continues to meander and meander and meander to the downside. Look at a Gilead, ticker symbol GILD, perfect chart for this kind of trade for quite some time. Okay, we've got our long put, bearish, right? Long puts make money for us when an equity is falling. We add the short put as our risk limiting instrument in this trade. Okay, so we're combining the long-term long put, 3 months or more of time, and a near-term short put at different strike prices. How do we choose that short put? Well, we look Once again, at the charts, we look for how far we think an equity will fall during the time frame of this put that we are selling. Okay, we use our technical skills for that. Maximum potential reward is at the strike of the short put when managed for a single expiration period, but just like on the call side of things, if managed over a longer time period, maximum reward theoretically unlimited. So basically what we've done is we've taken that profit and loss graph that you just saw with the call side and we've just repositioned it now. We're now on the put side. So profitability comes from the equity declining in its value, right? Losing value in the shares. And that is where profitability comes into the trade. It is still a range bound scenario, okay? But to the downside. So here's a theoretical example, right? Where XYZ, same XYZ that was trading at 31.50. Now we're going to the put side of the chain, buying to open the 132-day strike 32 long put at the ask of $3.10, selling to open the 27-day strike 30 short put at the bid of 62 cents. And once again, I like this setup because I'm getting almost 20% of the premium of my long put in my short put premium. Okay. Net debit, $2.48. Worst case scenario, we're completely wrong. Can't adjust, $2.48 per share of risk. Primary exit, short put expires, close the strike 32 long put, or close at the loss or make adjustments is what we're going to do. In a stagnant trend, what might our long put be worth when the short put expires? Just like we did on the call side. Same thing here on the put side, where we take the bid value being the wholesale value, the value price at which we sell options back to the market. So we take that value for the long put and, of course, theta decay that put. So for 27 days, we would lose roughly 29 cents of premium in that long put. So now, if we take out that theta decay, we could theoretically sell the long put back to the market for $2.71. Would we be profitable? Yes, we would. Slightly. 23 cents of profit, 9.2% in 27 days. That is in a truly stagnant scenario. And once again, we are not taking into account, and this will come to account, of course, to some extent, but we're not taking into account changes with implied volatility. So let's talk about implied volatility for just a moment. Okay. Last week, for example, going into the weekend with the primaries, right, coming up in France, with headlines from North Korea, which we still continue to hear about, all of these sort of geopolitical things going on across the globe. And the thing that we saw last week was that the VIX, which is a predictor, albeit not the best one all the time, but a predictor of how much equity movement we're likely to have from the S&P 500. We also, those of us who are traders, we know that it's loosely called the fear gauge, and it kind of just gives us an idea, generally speaking, of are premiums expensive or not, right? Now, obviously, it's always equity specific, and you notice here with these option chains that it's actually strike specific. Notice how we have different levels of implied volatility for each and every one of these options, okay? And on any given day, the change in implied volatility can be different amongst these options, okay? Just to kind of further compound the situation. But I bring this up for a reason, okay? So last week we kind of had, you know, a little bit of that gradual sell-off. We really did for the first part of the month, which is a fairly typical anomaly. April is usually a bullish month for the markets, but historically speaking, the first part of April tends not to be, and they believe it's because of taxes. Because some of the big money that moves markets has to sell some positions to pay some taxes, okay? And guess what? That's kind of a little bit what we saw coming to play. It wasn't really that we got very much of a sell-off. We just didn't get a lot of movement and certainly not a bullish movement. Okay, so we fast forward, we get past that, but then we have all of these geopolitical forces coming to play. So what happens to the VIX? It went up, didn't it? It went up, you know, pretty decently. I mean, for the way the VIX has been moving lately, let me put it like that. In historical terms, no. But compared to where we've been lately, we got a nice rise in the VIX. Now, what that did is it made premiums a little juicier. Okay, options a little more expensive. You have to remember that these put options are used as insurance. By the way, here at Options Animal, we teach you how to use these put options as insurance on your portfolio. Okay, because at some point in time, markets change and bearishness will come to play, and it will be very important that you know how to do that. So if you had gone in last week ahead of this primary over the weekend and all of these headlines and all of these things coming to play, right? And you had positioned accordingly, it's possible that you could have come into the week before at the beginning of the trading day yesterday, before things really started to take off, and because of the decrease in implied volatility, particularly in the shorter term options yesterday, you could have been wrong on direction but not had a horrible loss because of the positioning with implied volatility, because that implied volatility was really elevated in the shorter term options. That being said, if you don't understand those factors, it can be a huge headwind to success in using options, okay? Because these changes are really important to what happens with premium, okay? All right, all of that being said, what I did last week, by the way, is I sold premium for profit. When premiums got elevated the way that they did, sold some premium for profit. Okay, what if the equity is slightly bearish and trends down to 30 at expiration, back to our put diagonal, right? This is where we're expecting it to go towards, the strike 30 put that we have sold. What might our long put be worth now? This is where we get to go in and we get to add delta, okay? Our long put delta is a negative 0.4722 cents per share. So if our equity falls $1.50 down to that $30 level, that means we're going to gain 70 cents of premium in the long put. And when we add that together, notice, theoretically, we could sell the put back to the market for $3.41. Our profit now, 93 cents a share, or 37.5% profit. Okay? So hopefully you've seen on both sides, the put side as well as the call side, the sorts of profits that you can achieve in trades like this. Again, this is why they're so revered amongst our community, and not just our community, but with option traders who have a thorough knowledge of options, how options function. These can be fantastic trades, okay? Because what we're doing is we're hedging. We're not exposing ourselves 100% to the Greeks as we are with long options, but yet we can still get phenomenal returns. I mean, 37.5% return on risk in 27 days. When you annualize that, hundreds of percent per year on these sorts of trades, okay? Once again, I want to compare diagonals and calendars. So this is our put calendar versus our put diagonal. And the biggest difference, just like you saw with the call side, is right here in the net position delta to start with. So you notice in this case, with a put diagonal, almost 3 times as large a negative delta for the diagonal as compared to the calendar. Okay, so we're starting off from the get-go, so to speak, from the beginning, with a more bearish expectation, and more degree of profit will come from bearishness in this trade. And you know, the thing about the put side as well is that, have you noticed, and I'm generalizing, generally speaking, that when equities are falling, that is a time when you could potentially get perhaps a little more gapping kind of behavior, a little more day-to-day swinging kinds of behavior, right, when equities are falling. And it's that fear versus greed sort of emotion, I think, that comes to play. And so this is where a diagonal can really, really be helpful, because it can ride those waves a little bit easier, so to speak. Okay. So the type of diagonal, whether you choose a call diagonal or a put diagonal, should be chosen to reflect the expected trend. So in other words, a call diagonal optimizing a bullish trend, a put diagonal optimizing a bearish trend. Your short option is normally sold at a strike price that optimizes that trend. Okay? The objective is to sell the short option to lower your cost basis in the trade without the short option being assigned. Now, I'm going to say this on the one hand, okay, and then I'm going to take it right back for just a second. The short option could be sold at a higher or lower strike than the long option. Let me ask another question back here to that chat box. Do any of you ever take assignment on your short options, particularly your short puts? Do you ever desire assignment as a secondary exit? Do you ever use any short put based trades as a means of acquiring shares at a lower price? I'm just curious, really quickly. I've got a no. John, you usually roll them over. Okay. Sandy says yes. Let me tell you, this trade, the put diagonal, can be a fantastic way for you to acquire shares, should you desire to. Now, let me say this. You certainly don't have to. Most of the time, I agree with those of you who aren't taking shares, but let me just say that this can actually, if you desire to acquire shares, and rather than pay market price, okay, which we can do at any given point in time, you want a little discount. That's how I like to acquire shares. I want a discount. This can be a fantastic way to do that. You can actually, and this again, what I'm doing is I'm alluding to where it is we go inside the curriculum with all of these kinds of trades. You can actually position this put diagonal in such a manner, different than what I've shown you today, where you have extremely little cost, little debit risk in this diagonal structure. And if the equity were to fall beneath your short put and you were to accept shares, you actually have a built-in protective put, as we call it, a built-in long put further out in time on the trade. It's really, really fantastic. And one of our, there are over a half dozen of us instructors, and one of our instructors will use this a lot to acquire shares in that manner. Okay, so again, I'm just trying to sort of show you where it is you can go with this here at Options Animal in terms of being fluid, learning how to ride the ebbs and the flows of these markets fluidly across time. Keeping in mind, of course, that if the structure of the trade presents additional risk beyond the debit itself, so in other words, if you sell a put at a higher strike price than that long put, if you short or sell a call at a lower strike price than the long call further out in time, you will also have, even though it's a debit trade that you pay for up front, you will also have a margin requirement, something to keep in mind. Okay? So, just like, oh, sorry, one too many arrows. Just like with the put, the call side, the put side, close at a % return on investment. Again, that 25 to 50% is a really good window to use. Closed when the short put expires, or manage over multiple expiration series to achieve profitability. So if we're slightly bearish to stagnant, that's where the profits are going to come from. If we move too bullishly or too bearishly, again, too much of a good thing, too much bearishness can be an issue for this trade, reposition those short options, okay, to effectively work with the trend that is developing. How do you do this? How do you know when to do this? All those kinds of details. That's what we teach inside the curriculum, okay? So we know that the best time to plant a tree was 20 years ago. The second best time, of course, is now. And to this end, we have a special offer for you here at Options Animal. Okay, and this is our way of thanking you so much for taking time out of what we know are busy schedules for the past hour or so to listen to what I had to teach you today about diagonals. So the first 7 callers this evening are going to lock in a special discount, 25% off any membership that you choose to purchase with us at Options Animal. Now, we're not a one-size-fits-all shop, so we want to just have a free consultation with you. By the way, you can call in today, and if you don't have time right now, to discuss a lot of particulars. It's not a problem. 2-minute phone conversation, you lock in the discount, and we'll set up a time for you that is convenient to discuss this. Some of you may have a lot of questions about what we just went through. I mean, I did cover, I realize, a lot in a short amount of time, and we want to get those answered for you. Remember, once again, that here at OptionsAnimal, for the past over 7 years, and we have all the statistics, and we are more than happy to provide this for you, 90% of our trades here at OptionsAnimal are closing profitably. Okay? Now, the way that we accomplish this, over 60% of our trades, I'm running out of room to write on, 60% of our trades, over 60%, close at what we call a primary exit. And that just simply means, for example, with a diagonal, right? We position, we get the move that we're looking for, we take profits. Mo, you're asking a perfectly timed question, which is, do we just teach or do we give trade ideas? Perfectly timed question. This statistic that I'm sharing with you, this 90%, is from something called our weekly trades, okay? And so students who subscribe to the weekly trade service, each and every week, one new live skin in the game trade. In other words, these aren't paper trades, okay? These are real trades. One new live trade is placed in the markets, done by the instructors, and as I mentioned, I happen to be one of them. And the purpose of these trades is educational. We want for students to watch us use the 6-step lather, rinse, repeat process that I've talked about today, right? We outline that process for every single one of these trades, okay? And as I said, over 60% of these trades need no adjustment, go to the profitable conclusion. But the ones that do need to be brought back around to profits, those are the ones that are so wonderfully impactful for the students, but just because they watch in real time as we go in and we fix trades that would be losers, that would be a drag on a portfolio, we turn those trades into winners. The average duration, by the way, on our trades, okay, the average duration is 62 days, so just a little over a 2-month window for time. The average return per trade is 16%. So what that calculates to is a 96% annualized return on these trades with a 90% win ratio. Those are our results across the years using the methodology that I just showed you today and so much more. Okay, so if you do join us before this Friday at midnight, these weekly trades that I've just referred to, you will receive those free for the first year that you're a student with us. Now, you know, I have to give you the unfortunate story of losing money in the last bear market, but that's what happened for me, and that's how I found OptionsAnimal. Okay, I haven't traded a bear market yet. Really looking forward to it, to be honest with you. The thing about bear markets, if you've never experienced one, is if you have the tools and skills that you need to trade it, it can be phenomenally profitable because markets fall much faster than they rise. Okay. I say that as we're breaking out to new highs. It feels ridiculous right now, but it won't at some point in the future. The good news is we teach you how to trade the bull. If the bull wants to run for many years, not a problem. We teach you trades like that call diagonal that can get you these sorts of returns. Okay, but ultimately, when the market shifts, it will once again be about finding opportunities to trade in that environment as well. And that is what we provide for you here at OptionsAnimal. Okay, so our phone number is 1-888-297-9165 if you're here in the continental U.S. If any of you happen to be out of the country, an international presence, I like to say 1-801-331-7500. So thank you all very much for your time, attention, great questions and comments as well. Dawn, as always, it's a pleasure to be with you. Thank you for allowing OptionsAnimal the opportunity to talk about these fantastic trades with this great community. So thank you all.